Good morning, everyone. I'm Martha Stokes, Chartered Market Technician. We're going to talk today about what happened this week and what pointers you should be paying attention to so that you don't get whipsawed or have problems in this earnings season. One of the things I'm watching very, very closely is HFT gaps up and gaps down because HFTs are now using AI extensively and they're learning the painful way that the AIs are not perfect and they can make huge, huge mistakes and errors in what is going on in a stock or the earnings reports. Now, yesterday, Honeywell was the darling of the whole market. It gapped up nicely with an HFT gap up, and then today it's running down. Now, why is that? If it had such great earnings report, why is it selling down? Why isn't it continuing to move up? You would assume that it could continue to move up, but it does not. And this is not profit taking, folks. So let's go back in time and take a look at what's happening. This stock had a resistance level that it failed to overcome. There is dark pool rotation going on in the stock. You can see it as it starts slipping down. Then there's some selling short and some more selling short, some buy on the dips and some other things that boost it back up. But generally speaking, it has been trending down well ahead of its earnings report, and after the last report was not so great, so it also started going down as well. The gap down is from the prior earnings. Honeywell is in the aerospace, and it has a lot of different activities that is going on. It's an aging company. But what happens that you don't realize or may not have heard is that this, the CFO of a company can move what is normally considered an expense, like a software development and so on, is usually considered an expense. And they can move that to the balance sheet as a depreciable asset. And when they do that, they can boost their earnings to the point where they are able to present to the earnings report release date earnings that are better than expected. Okay? This happens all the time. GAAP is approves that. The general accounting principles approve that. It is not something that is illegal. A lot of companies do that to boost their earnings before the earnings season to make it look good or beat expectations or meet expectations. But in reality, it isn't. And how do you know that? You check the revenues. You check the this whole stock chart is saying there is something wrong with this company. Yes, it's bouncing up a little bit here, but this gap up was an anomaly because something is wrong with that report. There's something that is not happening that should be happening with that report. And so it boosted the whole market. Oh, Honeywell gapped up. Everybody runs to buy everything. There's a lot of people buying penny stocks or illiquid stocks on high risk things because the HFTs gapped a massive amount of illiquid smaller companies yesterday. And of course, all the gurus are saying, buy these stocks, and they're going to crash and burn. And a lot of people are going to lose money. And I just can't stand that. That's really not necessary. Everything you need to know is in the chart. The stock gapped up probably because the CFO adjusted earnings, as he is rightly allowed to do so. It sounded like a great earnings report, and HFTs fill the queues. Now, it is not the lot size that fills the queues. It's numerous amounts of small lots. It is not the size of the lot itself, but the number of lots that are on the buy side or the sell side. If a huge surge of small lots are on the buy side, the computers of the market, which are just dumb computers, they're not AI at all, will price the stock up higher because there are no sellers. So they gap it up higher, and then perhaps the sellers will come in. So that is how that works. You always want to be concerned with, did the CFO adjust the earnings statement? Because if you have lower revenues, how can you possibly have higher earnings? That's an anomaly that none of you are paying attention to. The other thing is that who cares about year over year? That's ancient history. You need to care about quarter over quarter over quarter over quarter, at least 4 quarters, 6 preferably. You can get the quarter over quarter from the NASDAQ or some of the other websites that you look at. and you can check those. And I would take and make a picture and snag it and keep an eye on it like I do, and then I can compare 8 quarters. Now, is the company's earnings and revenues growing and growing and growing quarter over quarter? Because if that's happening, they're on a growth spurt and they're going to continue to have good earnings for quite some time. They could have good earnings for 2 or 3 years. If it's up and down, then they've got problems, and they're chasing. Honeywell is up and down, and it's trying to reinvent, and it's trying to lean on the fact that aerospace is in favor right now, and everybody thinks we need aerospace and defense in particular, and that we should have this. So it's using it what it can and its accounting principles to adjust it to give itself a gap up. This gap was a jump over some resistance, but not a true breakaway gap, which would have occurred if it gapped all the way up here. So it is something that you need to pay attention to. What I see right now in the market with the earnings season is a lot of companies are having a small up day on their earnings, but they're not having a huge spectacular gap up day. I'm trying to analyze, is that because HFTs are not front running and filling the queues with these, or is there something else? HFTs have had to adjust their AI because they made so many mistakes in the last couple of quarters. It was a disaster. And a lot of times it really hurts. So one of the things I'm keeping an eye on right now is Amazon. And I'll give you my summary next week. Amazon actually had a major crash of its hardware on its AWS system. And it was down for hours, and it affected Coinbase and all kinds of other companies that rely on that hardware to function. Everything that's AI or cloud or internet is all has to be supported by hardware and firmware beneath it. A lot of people forget to think about that. So why CrowdStrike had a cybersecurity breach and it fixed it in 3 hours. Amazon's didn't have we don't know whether it had a security breach or not, but we do know that it had a major crash in one of its major centers that is the AWS system and keeps everything running. So it managed this very carefully because it had seen what a CrowdStrike had a couple of years ago, massive gap down on a very simple thing that they fixed immediately. And it took a long time for their stock to recover. Amazon doesn't want that to happen. So they're keeping a very low profile. They're keeping it very quiet. They're pulling it out of the news and keeping it soft and tangible so that nobody panics and nobody sets Amazon's stock price on fire going down. They don't want that. So they have been able to mitigate the action, but we don't know exactly what happened, and they're not talking about it much. They're saying it's fixed and it's operational again. But one of the biggest things that all of the corporations are worried about this year is cybersecurity. It's a good place to look for stocks to invest and trade in. I don't recommend stocks. I know that you can find your stocks yourself. If I teach you how to read stock charts, as well as you read a book. And it can be done. It takes some practice and it takes some time. So we're looking at Honeywell and we're going, maybe that report wasn't so great and wonderful. There's something not right with it. Otherwise, it could continue to move up. This is not profit taking. This is selling. And you can see it in the pattern starting here that there's a rotation out of Honeywell by the dark pools, the buy side institutions. That is something important that you need to remember. Amazon, I'm researching right now, and I will get back to you and get you some information about it. But it didn't have a crash, and it should have. So what stopped that? It's very important to study. We have support here for this stock, but we need to question the whys. When you're getting into a stock before earnings season, which is what I recommend, you're getting in at the best time. If it has a run and it's running up and you can get into that run at a reasonable low risk entry, that's fabulous. That's where you should be. Jumping into a stock that releases news that appears to be good is a very dangerous proposition right now because HFTs and pro traders are all experimenting with different things, and you may get into a whipsaw trade that can take you out and cause you to lose money. That's what I'm talking about today. I hope you have a good weekend. We have more earnings coming next week, so get ready. I'm Martha Stokes, and that's my discussion for today.